Financial Accounting 14B, Empty Shelves and the Cash Conversion Cycle. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, the email, and the website. This is taken from a blog post that was inspired by an article that was out of the Wall Street Journal. I posted it back on May 5th. And I start off by defining what the cash conversion cycle is. This is all about cash out the door and getting it back in the door. And specifically, the cash conversion cycle represents the time it takes in days, let me hit undo there, to convert resource inputs into cash flows. And by resource inputs, we mean assets, things that you use in your business to make money. If you're a manufacturer, that might be direct labor, direct material. If you're a service provider, that's out spending money on tax return software if you make tax returns, or buying inventory for your store if you're a retailer. So let's say you buy towels from a supplier and you sell them in a retail store, and this relates to the article that we'll get to. The towels you purchase in an inventory are considered assets. They're assets because they're something you use in your business to make a profit. Now, the tricky business is planning your cash flow. You need enough cash to buy your towels into inventory, and then you've got to have some place to sell the towels. You need to build and operate your stores. That means you'll incur costs for payroll and advertising. So you got to have cash to operate until somebody walks in and buys towels and pays you cash. And then I repeat the definition here, and it's about the cash that goes out until you sell something and cash comes in. And the question that came to mind when I read this article was, what if a court decision prevented you from stocking the shelves with the product that you wanted to sell? And that gets us to this article from the Wall Street Journal, and I have the link under here. And the important things for this discussion is that a New York State Supreme Court judge told J.C. Penney, the retailer, that the firm took a risk by buying towels and other products from a company founded by Martha Stewart. Well, why did they take a risk? Well, Macy's, another large retailer, is claiming that they have the exclusive right to sell the Martha brand merchandise. Now, there's a legal issue here, and that's not the point I want to focus on. I'd want to focus on the cash and the accounting impact. If J.C. Penney bought a product and put it and stocked it, and now they can't sell it. So let's consider that J.C. Penney already bought the inventory, and they might be prevented from selling it. In fact, this article was written in May, and the inventory was targeted to be sold in May, so they were planning cash flow, assuming the cash was going to start coming in the door in May or shortly thereafter to recover the cash that they invested in the inventory. So there's a whole bunch of problems, and here are a few of them. If Penney is not allowed to sell the Martha Stewart inventory, they need to replace it with something else. They need to sell something. They need cash to buy the replacement inventory, and the trouble is they've already used cash to buy the Martha Stewart inventory, which they now, it's a good likelihood, can't sell due to this legal issue. So where do they get cash to buy more inventory? Well, one way to generate cash is to sell the Martha Stewart inventory. Unfortunately, the buyer may be the very company, Macy's, that's in litigations with Penney, because they're the only ones who can sell the product. They're the only ones who would consider buying more of it to put on their shelves. There's nobody else for Penney to sell to, except back to Martha Stewart, in which case they certainly take a loss in the sale of inventory, and Martha Stewart contractually may not want to buy it back or be obligated by contract to buy it back. So, if the scenario plays out, Penney's would end up with less cash to use to buy the replacement inventory, because they'd be selling the old Martha Stewart stuff at a loss. They may have to raise funds to have sufficient cash to purchase different inventory, which means they got to issue stock or bonds. They've got to raise cash. Another problem. All of the marketing and advertising and store displays to date were designed to sell the Martha Stewart product. Now, it's likely that the firm would write off their prior spending on the Martha Stewart at a loss, all that prior spending on marketing and advertising store displays. But now they've got to decide, Penny have to decide if they want to market the new inventory. How do you get the word out? Is it important to get the word out? Because bear in mind, you were going to start selling the Martha Stewart inventory in 60 days. That's not a lot of time to get the word out. So do you invest heavily in marketing and advertising? And if so, where do you get that cash? So think about the cash conversion cycle before and after the change. Here's the original plan. Penny spends marketing and advertising to sell the Martha Stewart line. They buy Martha Stewart inventory. Plan is to stock the store shelves and start selling the product in May. So, as I mentioned before, some cash collections would start in May or shortly thereafter. That's where you get the cash inflows to cover your cash outflows, and life is good. But now let's think about if they have this court loss, and we don't know if they do yet or not. The cash flow can be dramatically different. First, Penny's may take a loss on reselling the Martha Stewart inventory to someone else. They need cash to buy the replacement inventory, and they have to consider a new marketing campaign to sell a different product. One more question. Will customers even buy the replacement product that's not the Martha Stewart? We've been conditioning, marketing, promoting Martha Stewart. If we give them something that's different and it's perceived as not as good, will they buy it? And how will the new sales compare with the original plan of sales? Because that has to do something with planning cash flow. It's directly related to the revenue. These questions have a huge impact on expected cash flow. So you can see the huge issues that this company faces because the shelves are empty. We don't have the product that we were planning on selling, and we've got a real problem with cash conversion cycle. That's as far as we're going to get on this video. I wanted to point out that on the website, we have our toughest accounting topics, which are small group live chats on some of the harder issues in accounting. These are issues that I'm asked about all the time for tutoring, so I have classes that go on to teach those. And finally, wanted to talk about the new book also, Cost Accounting for Dummies, is now out on Amazon.com. Thanks for watching, and we'll see you next time.